Good morning and welcome to the Prescient Investment Management multi-asset webinar for Q4 2022. My name is Natalie. With me today I have Bastian and Rupert. 2022 has come to a close and it was a year shaped by great uncertainty. It was a particularly tough year globally as markets reacted to China's zero COVID policy and the Russian invasion of Ukraine, to name a few, leading us into near record high inflation in the US and subsequent aggressive interest rate hikes by the Fed and the SARB. So there's a lot to unpack here, so I'm just going to jump straight into it. Rupert, looking at the past year, what would you say are the defining moments?
Thanks, Natalie. So, what a year it was. Coming into 2022, we came off a rally in the equity markets, South Africa up around 30% on the rebound post-COVID. S&P was up around 40%, so serious momentum within markets. We had the Omicron variant, which had extremely high infection rates in South Africa, but the mortality rate was relatively low. So on balance, we were relatively optimistic. Then, of course, we always have a left tail event. Vladimir Putin invaded the Ukraine in what he called a special military exercise. Natural resource prices, in particular oil and gas, went through the roof. In an environment where inflation was priced to peak somewhere in Q1, Q2 of 2022, we actually ended up with inflation which only peaked right at the back end of 2022, with the Fed and the SARB being priced to cut rates coming through the second half of 2022. They continued to increase rates. The new environment meant that inflation forced the Fed to increase rates 75 basis points when the old normal was 25, so something completely out of the ordinary. And we experienced a year where global equities sold off at one point around 30%. They finished down around 20%. South African equities were largely protected, finishing flat to positive. So a very big disconnect between South African equities and global equities, where one of the largest disconnects on record that we've ever seen occurred. One other thing that we saw, in particular for multi-asset funds in the first quarter of 2022, was a revision in regulations, specifically Regulation 28 for retirement funds, where retirement funds could now go 45% offshore instead of the previous 30% limit. That enabled a significantly greater amount of freedom amongst allocators, and we saw a significant amount of dispersion amongst multi-asset funds in South Africa in 2022.
Certainly a year full of many obstacles and a very steep learning curve. So Basti, what would you say were the key takeaways or lessons learned for you from the past year?
Thanks, Natalie. And also welcome back to everybody from my side. Let me start by saying there's always learnings to take. I don't want to call it too much of lessons learned, but definitely quite a few key takeaways. Most importantly, I think diversification once again remains super important. Don't carry too many concentrated risks. Also be humble about your investment approach. Never expect that you can predict the future to perfection. We saw a lot of tail events, as Rupert mentioned earlier, which were really out of any previously observed distribution. So a very different year once again, and also key to highlight patience. Like if we speak about equity returns, if we speak about equity markets, a balanced fund which runs with a high equity allocation, you need time for these risk premia to come through. So there will always be years of underperformance, and not necessarily underperformance on the fund point of view, but underperformance in terms of the asset class underperforming. And it takes a while for the risk premium to come through. As all of these are key takeaways, none of them actually learnings. Do you want to sound humble and not arrogant by saying that we have, it is something which once again came out quite starkly, but again we have, those are phenomena which we actually know materialize in financial markets over the long term only.
Any key takeaways from you, Rupert?
Yeah, I think from my side, one of the key takeaways is to stick to your knitting, so they say. So stick to your process, base it on sound research. If you've got evidence behind what you do, don't just switch your positioning because it's not working for you. If you've got solid reasoning as to why you're in a certain position, stick with that position. And it will come right. I mean, South African equities had a nice rebound in the fourth quarter, as did global equities. We finished the year a lot better off than we were in multi-asset in general in Q3. And that's because multi-asset funds are long-term investments. They go through periods where they do underperform, and they go through periods where they outperform. They're looking to perform along the lines of CPI plus 5 or 6. If you need CPI plus 2 or 3, then you would look to allocate towards something like an income fund, which Prescient is very well known for. It takes a lot less risk. It's not going to give you CPI plus 7, CPI plus 6 over the long run, but it allows you to have that risk management process in place. If you need a bit more capital growth, as many pensioners do, with a long-term time horizon, then you have to invest into growth assets like equities, property, etc. And they go through cycles. They sell off and they rebound again.
Okay, so before we get into the nitty-gritty, let's take a step back and look at global growth for 2023. Basti, what can we expect to see here?
Yeah, it's going to be a challenging year once again. So that's unfortunately most likely the reality. Global policymakers, but also global economists have resigned on the fact that 2023 is going to be a year of low growth. Why do we agree with that view? Well, you don't have to go too far. I mean, I'm going to show you some data points just now, but the last year has been basically a year full of high inflation and massive interest rate hikes. So with that, you would expect these hikes to eventually come with a lag of 12 to 18 months into the real economy, into global activity, and that's what we're seeing now. So there needs to be a slowdown, and that's what we expect as well. But just to take one step back, the signs are already built. Like we have 2021 after COVID in 2020. 2021 we saw 6% global growth, or 6% growth in the States at least. So massive, steep, V-shaped economic recovery, and then we lost momentum. 2022 already we went down to just below 2% of growth in the States, and now based on this weakening momentum we are starting 2023. So from a pure economic point of view, we don't have our hopes up that high. There are good signals for some of the asset classes, but from an economic point of view, we would be quite cautious. But it's probably easiest if I can just show you 2 or 3 charts. Okay, so as always, we like to focus on the facts, on the data, and have a more scientific look at things. So we start by showing the Prescient Economic Indicator. It says US equities on top here because we're looking at the US Economic Indicator. We're going all the way back until the 80s here, but I'm going to zoom in a little bit to focus on the more recent history. So you can see that this indicator is particularly good in picking up the burst of the dot-com bubble. It picks up the great financial crisis, picks up COVID in a very timely fashion here. March, April, we already know there's a steep slowdown coming. And where are we now? You can see the line is quite jumpy, quite fast moving, but clearly it's below the red line, it's below the zero line, which doesn't necessarily mean we are heading towards a recession, but it means that we are going to grow below trend growth, which is probably close to being in a recession. Good news is this indicator doesn't really tell us that the recession is going to be particularly deep or particularly pronounced. For that, we are just simply not there yet. Let me give you another example. I want to show another indicator. This is the economic surprise index, which we use to track whether economic data prints are released above or below of economists' expectations. If I zoom in on this one as well, you can see that not only has economic data in the States slowed significantly, you can see that as of recent it also has underperformed the expectations. So another hint towards a slower economy. And last but not least, I mean, I can really go into this economic picture as deeply as it gets, and it tells us the same story. I can also show profit margins of the big corporations within the S&P 500. You can see that they have started to roll over as well. And that's normally something which you see at the end of the business cycle once we head towards a recession. So the story lines up here quite clearly, unfortunately, towards significantly lower economic growth. And remember, last year we're coming out of just 2%, below 2% growth. So yeah, we'll see a slowdown this year and potentially most likely a recession. Another indicator which we like to show, the shape of the US yield curve. Okay, we don't like to show the actual shape. We measure what percentage portion of the US yield curve is inverted. And that percentage right now amounts to almost 100%. So that means the front end being priced to almost 5%, and then from there, the curve is only downward sloping, showing that 98% of the US yield curve is currently inverted, which is normally a quite reliable indicator for a recession as well. So long story short, Natalie, a lot of indicators are pointing us towards a recession, a slowdown this year, but we are not necessarily in the camp of predicting doomsday, because it doesn't really look all that shocking yet by looking into the hard data.
Thanks, Basti. So not all doom and gloom, but still some pressures lingering from 2022 as we head into the new year. So Rupert, maybe you can take us through the current outlook for asset classes in 2023.
Yeah, absolutely. So Bastian's taken us through some of the macroeconomic indicators. For us, how does that actually apply in practice? We base everything on evidence. So our asset class views are based on statistically significant interpretations of those macroeconomic variables, amongst other things. So let me take you through the asset class views that we have currently for asset classes in 2023. Right, so looking through our asset classes, an overview across the world, we run 28 asset classes within the multi-asset team at Prescient. We have a mix between strongly negative all the way out to strongly positive views on asset classes, based on what I like to call a distillation of different underlying factors. And it gives us a very concise way to view global asset classes and to navigate our multiple multi-asset offerings through what we know is an uncertain world of investments. So just going through the asset class views, starting with equities, we have a moderately positive view still on South African equities. This is an interesting view, and I'll take you through it in a bit more detail. But in essence, it's because the value case still exists for South African equities. There are admittedly headwinds from global growth, but there is nonetheless quite a strong value case from a fundamental basis for South African equities. US equities, on the flip side of the coin, has got a very strong negative case from a valuations perspective. So what's changed there? US equities have had quite a strong negative value case for quite some time. What they were buoyed up by, though, was a strong growth case and strong financial conditions. That has since switched to a negative. Bastian showed you our nowcast of the economic growth outlook for the United States, showing that it is below trend growth and implying that it's more difficult for US equities to grow their way into their top-heavy fundamental ratios. Looking at the bond space, SA bonds, we still are bullish on, moderately positive, still significant value there, quite a strong carry trade versus the United States. Despite the aggressive hiking path that the Fed has gone on, we know the SARB has also aggressively hiked, not quite to the magnitude of the Fed, but it has kept up with the Fed such that there is still quite a strong carry trade. US bonds, we're moderately negative. That's for a mixture of reasons, but in part because the current real yields, albeit a positive real yield, are not high enough to justify a strong view in the positive sense on this asset class. Going down into the real asset space, linkers we remain moderately positive on, similar to the bonds case. Linkers are offering a very strong pickup, especially in these times where inflation is high. We're seeing a strong case for a long-term investor to buy into inflation-linked bonds. SA property also offering quite a strong case from a value perspective. And then lastly on the Rand, strong positive on the Rand. We're seeing a nice recovery in the Rand since Q4. In essence, that's driven by the carry trade. There's a very, very strong relative yield that you can get by investing in Rand-based assets compared to offshore assets. So the Rand remains, in our view, undervalued and has significant upside from here. Going a bit more detail into each asset class, if we look at SA equities to start with, the split between the different families of our indicators, those being valuations, economics, financial conditions, and sentiment, it's largely positive for South African equities. As I mentioned, a very strong positive case from a valuations perspective. Economic headwinds, and that's a function of global economic growth slowing down. And then sentiment and financial conditions showing a mixed to positive outlook. Overall, that brings us to moderately positive on South African equities. And you can see that through time, we've come off a strong positive towards the back end of 2022 and the start of 2022 into now a more moderate view on SA equities. The predominant building blocks for that asset class outlook: price to earnings ratio, as mentioned, still looking very attractive. And let me just show you that in a bit more detail, because it's very interesting to see that despite sell-offs in global equities and despite the rally in South African equities in 2022, there is still a significant value case. So the price to earnings ratio, if we look on the very far right of this chart, still sitting around 10 times, implying that there's a very, very strong, attractive case from an earnings perspective to invest into South African equities, at least relative to its history. Okay, so what does that look like on a forward basis? What are the expectations embedded by analysts within the market? Also, well below that long-term median, currently sitting at around 11. So that shows that there is a positive outlook, or relatively positive outlook for South African growth, whilst there is also a relatively strong value case for South African equities. So what are the headwinds? Well, if we look at headwinds across the other indicators, we're seeing a yield curve which is strongly inverted within the United States. Bastian showed you the indicator on the yield curve. What that implies is that the global markets are a lot less prone to take risk. And South Africa is seen as an emerging market, which means there's a strong headwind towards capital flows of investments into South African equities. Similarly, we're seeing headwinds on funding pressure, business sentiment. One of the main reasons for the business sentiment having surveyed as being negative is, of course, the outlook from Eskom. Stage 6 load shedding, not great outlook for certainly for underlying business prospects in South Africa. Okay, so that brings us to a moderate positive on South African equities. Just want to contrast that with global equities quickly, because it's essentially the flip side of this coin. We're seeing valuations which remain strongly negative in US equities. That brings us out in aggregate to a strong negative overall on US equities, where we have been for quite some time. So that relative value trade of 2020 worked out quite well, where we were bullish on SA equities and bearish on global equities. Just looking at the same picture on a valuations perspective, price to earnings ratio is still in the red, implying it's still above the long-term median, and all the other ratios also deep in the red. Just to highlight the price to earnings ratio, this is very important for us because going into 2022, we saw a very, very top-heavy global equity market. Coming into 2023, it's actually not quite as top-heavy as you might think. So the PE ratio in particular, if you look at the journey that it took coming into 2022, sitting just shy of 30 times, it's now well back down almost at the long-term average. So it's not to say that US equities are extremely top-heavy, certainly not like they were in the COVID rebound, but they aren't quite attractive yet, let's put it that way. On a relative asset class basis, South African equities remain more attractive than US equities. Right, so if we look at the Rand, we're strongly positive on the Rand. This is also a very strong value case. We've seen a relative carry trade on SA assets versus global assets very strong. But it's also a mixture of other indicators. Economics, positive. Financial conditions, strongly positive. Sentiment, moderately positive. So all in all, quite good tailwinds on the Rand. We've seen some strength in the Rand coming into 2023. One of the interesting things about the Rand, though, is that it can be very attractive from a valuations perspective. But if the world is in a risk-off environment, they generally retreat to the dollar, even if the dollar is unattractive from a valuations perspective. That was what we saw in large parts in 2022. The Rand has remained attractive throughout, but what we saw is that financial conditions, economics, sentiment were turning into the negative territory. So the model was shifting into a moderate overweight or moderate positive and then back into a strong positive. And right now what we're seeing is that there's a general risk on within the world. Certainly coming into the new year, where we're seeing credit spreads having tightened significantly, funding pressure having come right in. Industrial metals, which is one chart that I wanted to show you on the Rand, has experienced quite a nice little V-shaped recovery, which is very strong for South African exporters, which in turn is very good for the Rand. So what you can see here is it had a very, very strong lift up to all-time highs, came off, and our view on the Rand changed during that time and has since lifted up quite considerably. So that means that there are positive outlooks for South African exporters, specifically within the resources sector for 2023.
Earlier, Rupert spoke about a pivot point in global monetary policy and how this could be a strong driver of asset class returns. Is this something we could expect to see soon?
It's a good question, Natalie. I mean, we have spoken about this Fed pivot, the second year of the last 2023, last year already, quite a bit. This year we're going to speak about it again. Whether it's going to happen or not, we need to look at inflation more detailed. But I can say already now the market has already priced for that. So even if it doesn't happen, it's going to be very, very relevant. The fact that it doesn't happen and the market has priced for it is a potential risk, i.e. higher rates going forward than originally priced for. But as mentioned, we need to look at inflation first because we spoke about inflation so much last year, so I don't want to bore anybody too much on this inflation topic, but it is definitive of global monetary policy and we will have to follow it once again cautiously this year. I like an analogy from John Williams, who's the governor of the New York Fed, and he basically says inflation comes in 3 layers. So there's an outer shell, like an outer layer, which is basically commodity prices like the oil price, energy costs in Europe, potentially fuel prices. Okay, so that outer shell is the first element. Things are coming off there, so prices are coming down, which is helpful, which is in line with our expectations, and part of the reason why last year we were constantly basically reiterating that inflation is going to come down. The second layer, though, is also important. It's a direct derivative from these input prices. It's basically the prices for goods. For example, we quoted used car prices or other consumer goods coming down. Even here, and we'll show that in the chart just now, in the inflation prints, in the last inflation print, we've seen that goods prices are coming down as well. So inflation coming down because of this second layer of the whole inflation conundrum are also coming down. So we've got 2 reasons for inflation to come down. What worries us a little bit is the very inner part, the core of inflation. So basically, what about wages? What about shelter? What about these bits and pieces of inflation? Because these core parts of inflation have proven to be actually quite a bit stickier than initially anticipated. So we've been claiming so long inflation is going to come down, and it continues to come down, and that's in line with our expectation. Yet we are worried that this core is a bit stickier than initially anticipated. But easiest way once again is to look at 2 or 3 charts. Okay, so as mentioned, inflation was one of the dominant themes last year, and rightfully so, I guess, because it has been definitive of monetary policy, and monetary policy in turn has been quite definitive of capital market returns. So let's look once again into inflation a little bit more casually. I actually personally look forward to the day where we don't have to focus on inflation every day, but this is where we are right now. Okay, so this chart shows CPI inflation through time. You can see that in a historical context, we are still at quite high levels, but we are coming off the peaks. So if I zoom in a little bit, you can see inflation is finally doing what we expected inflation to do, and that is coming down. Okay, so we had 9.1 at the peak, but then inflation came down to now 6.45 at the last print, and it will continue to come down from here. As mentioned, it's driven though by the outer shell, mostly by commodity prices and then goods prices, not yet by the inner core. Let me show you that in 2 or 3 charts as well. So I'm going to basically go into the direct decomposition of these elements of inflation, and I'm going to start off with some of the parts of the outer shell. So you can see motor fuel contributed 1.6% to the headline inflation print in March 2022, which is roughly when we saw the peak. If I just move down here, you can see that right now it's only contributing 0.6%, so much less. Another good example would be even like food prices. Okay, so they contributed more than 1%, coming down slowly to contribute less. So that's the very outer shell. The second layer, I mentioned goods. So we long spoke about new and used motor vehicles contributing 1.7% to top line inflation in March last year. That's now coming down significantly. The contribution is only 0.27%. So the outer shell, the middle shell, all of these are coming down. So inflation is coming down, top line inflation is coming down. So why are we still worried? We are worried about the last element of inflation, the core. You can see that core inflation contributed at 31st of March, call it kind of like the peak of inflation, March last year, March 2022, 1.6%. And now shelter prices, what has happened to those? You can see that those have actually continued to creep up. So trying to say the more demand side driven inflation has not really abated to the degree which we would be hoping for. And the demand side driven inflation is also what the Fed targets with higher inflation. So all is good, all is well, inflation is coming down, we are on track, but we have to be cautious and we have to monitor demand side driven inflation, because that could add an interesting twist to the story, and that's what the Fed is looking at very cautiously as well. So hence our take, inflation is coming down, growth is not that terrible yet, so monetary policy doesn't really need a massive amount of easing yet, and the Fed doesn't seem to be willing to give that easing anytime soon anyway. So the risk here is clearly, and that's why we're going to link into monetary policy now, that the market, despite of these facts, markets have already priced for aggressive rate cuts over the months to come.
Thanks, Basti. That was a great explanation on inflation dynamics. Can you dig into monetary policy a bit more? Would you say it's currently tight or not?
Yes, exactly that. So monetary policy in our measurements is not tight yet. It has tightened significantly. It's going to slow down the economy, but it's not excessively restrictive yet. And as mentioned earlier, that is not the problem. That's not what worries us. We're not worried about this deep recession yet. We're not worried about too tight monetary policy leading to that recession yet. We are not fearful, but worried a little bit about something else. We are worried about the fact that the market has already priced for aggressive rate cuts, and monetary policy, in our opinion, is not ready to deliver on these rate cuts which have already been priced for, which almost means implicitly, from looking at the market, it's almost like an implicit rate hike. So, but let me once again show you into his charts. Okay, so what we're showing on this chart in the red line, this is the Laubach-Williams natural rate, just for reference purposes. It's the same John Williams who's behind this model, and Thomas Laubach, who is the head of research at the San Francisco Fed, while he was at the San Francisco Fed. They developed this model, which actually predicts nothing else than the natural level of interest rates. So the natural level of interest rates basically tells us where monetary policy has to set real rates for monetary policy to not be restrictive, not be tight, but also not be expansionary. So basically, if you set your interest rate as a Federal Reserve to the exact same level as what the Laubach-Williams natural rate suggests, your monetary policy is exactly neutral. Sometimes you want to be easy, sometimes you want to be restrictive, but now we know what to measure against. And interestingly, this model has actually been discontinued, but at present we got hold of the data and we decided to do the calculations on our side. Okay, so what you can see here is basically a spike in the Laubach-Williams natural rate post-COVID. So that's when we were all speaking about massive productivity gains, steep recoveries, tighter labor markets. All of this would enable us to stomach higher real interest rates. Interestingly, we've moved back down now, so it almost suggests that we're heading towards basically a pre-COVID world. But let me not get ahead of ourselves. Let me rather focus on what that means for monetary policy. So we're going to compare this to the actual, we're going to compare that to the actual level of interest rates in the yellow line. So here we are seeing obviously much, much tighter monetary policy. So if you're below the line, you have very negative real rates. If you're above the line, you basically start to go positive. And interest rates have shot up here for two reasons. First of all, the nominal rates have gone up because of the hikes from the Federal Reserve. But secondly, also because inflation is now starting to come down. So that's why real rates are really spiking. And if I now overlay what we call ease of monetary policy, which is the gap between the two. So the higher the line, the easier monetary policy, the lower the line, the tighter monetary policy. You can see we've seen a lot of tightening, but we're not in tight territory yet. We're not below the zero line. Monetary policy is almost just about fine before, instead of being too tight or too narrow. Okay, so that's basically where we are. Not tight, not tight, but also not expansionary. So what does that mean for markets? So for that, I will look into pricing. I'm going to show another 2 line charts. Just want to take out this one and just focus on the current rate. So the red line is where the effective Fed fund rate is. You can see 4.3%. The Fed is targeting a band between 4.25 and 4.5. So basically this is exactly where we are. And then what does the market tell us where we are going? The market is telling us that we are going basically all the way up to 5% over the next 6 months, which is basically June 2023. But the interesting bit is now that from here, the market is telling us we're going to go all the way down to 3% by December 2024. And that equates to a 2% cut in front-end rates. That equals 8 times 25 basis point cuts, which is just a lot of cuts for the Federal Reserve to get into the system. And again, it's possible and it could materialize, but for that you either need massively lower inflation, which we think inflation is going to come down, but you almost need a deflationary environment to get 8 cuts in such a short period of time, or more likely you need a very deep recession. But that very deep recession we actually can't track in the data yet. Just to show this in one last chart slightly differently, I just want to contrast basically again US interest rates, so what the Federal Reserve is priced for 12 months forward. So you can see 12 months forward we basically still priced for almost 5%. Okay. But then 24 months forward, the stark discrepancy, we only priced for 3%. So basically this massive gap between those two, basically 8 interest rate cuts priced in the States. And that's what's worrying us. That's what potentially poses a risk. The market is really getting ahead of itself here, telling us we will see massive Fed easing as soon as 6, 12 or 18 months out.
All of these charts you showed us today are really powerful tools when looking at economic data. And it's clear to see that there's a lot of moving parts in the background. Do you think that being able to process and view data and information in this way is something that the industry should be moving towards?
Yeah, I think so. I mean, we're going to be biased in this direction, but I often get the question from be it school kids or graduates or interns, where should they focus their time and efforts? There's certainly a lot of merit in getting things like a CFA. You need those fundamentals to understand the world of investments, but equally as such, there is a lot of merit in learning how to program and to process these volumes of data. That's a world that in 10 years' time, 20 years' time is going to be a very, very attractive job. A lot of the traditional asset managers are now looking to recruit quantitative analysts. So for us at Prescient, it's very important that we stay ahead of that curve and that we do research which is pushing the boundaries and keeping us right at the very forefront of being the top quantitative asset manager in South Africa.
Yeah, I agree with that, Rupert. I mean, I see it exactly the same way. We are, the big transformation in asset management from our point of view is really happening in the data science space with just more and more data being available. Quality of data is improving, the availability of information is increasing, the computational power to process all of this information is improving, and we just see that visualizing how certain factors move together is just becoming so much more important and definitive of creating investment success. And I mean, in our opinion, the days are really gone where you could use a balance sheet of a corporate and look at the numbers and try to have an edge. So the traditional ratio analysis, the traditional predicting profits for individual corporates, these are things of the past. And I mean, not that if you give me a balance sheet of a corporate now, not that it's unimportant, so it carries the same information as it always has. So it's not less important today than it was in the past. The difference here is that markets have become more efficient. So if you show me a balance sheet and you work out a PE ratio for a company is extraordinarily low, you can trust me that the market has already priced for that. So all of this financial information is as important as it has been, but you need to apply your mind a little bit stronger nowadays. It's more important to process more information, and that's in line with our approach. So it's more evidence-based, it's processing much bigger data sets, it's processing information much quicker, backed by statistically measurable correlations. And by getting all of that right, that's where we really see our edge. And we are at Prescient, even to give you a little bit of a deep dive into the investment team, we have really made the decision to create a new role. We have a head of research now, which we didn't have before. Audra, who's probably the mathematically strongest person on the floor, has taken that role. So we can now say we've got the mathematically strongest person to head our research. This is where the industry is going and where it has to go. And for the years to come, we at Prescient are going to be more data-driven even, more information-hungry, and hopefully, as Rupert suggested, continue to basically drive and define the systematic investing landscape in South Africa, not just because we are so convinced that this is the future of investing, but also because we know and can measure that this is only to the very best benefit of all our clients.
I think there's just something to add to that, in that it's not a firm where there's a black box type strategy that charges 3% management fee. That's not what we do. In fact, quite an interesting survey result came out last year from Morningstar, where we saw within the multi-asset space, the average management fee for multi-asset funds in South Africa is 1.3% in the retail classes. The average management fee in the United Kingdom is 0.8%. The average management fee in the United States is 0.6%. So that fee compression is something which is a reality in South Africa. We're going to be seeing it more and more as we go through the years. And for us, the economies of scale are achieved through systematic processes. And we can get our fees down to as low as 30 basis points on our funds by leveraging off those data science skills and the massive amounts of data that we use.
Thanks, guys. Some sound reasoning there, and definitely something to consider as an investor. Basti, Rupert, thank you so much. Thank you, everybody, for joining us today.